Thank you very much, Raleigh, and Trading Pub here. And Yana also, thanks for her help and getting everything going for us. Just a little correction. I trade a boys basketball team, but I've coached, coached girls basketball team a couple times, and I find it pleasantly different than coaching boys. So, but no problem. Uh, yes, and you need multiple talents to coach a girls team, much more than the boys team. That's for sure. But that's another story for another day. But anyway, thank you anyway. And I think the reason that I think that might be important is because of what we try to do here, where we're trying to, coach our traders here to become better traders. And my background, as Raleigh mentioned, is the fact that I've been on the floor for 20 some years, and then over the last 5 years have converted up here to the screen, and have decided to have a little trading room there because it's very quiet in my office sometimes, and I just have a little bit of a tough time there trying to stay focused on what's going on. So we brought the operation down here to the floor, and I find it a little bit more interesting, not only for myself but also for the clients that are participating with us. And the pit noise does help a little bit sometimes when we don't understand what's happening or we don't know why the markets are moving. And so hopefully that keeps us a little bit awake here. Well, also the advantage of the trading floor is to be able to get some, conversation from the traders, a little talk from the traders that we get that I share with our clients, and that helps us in what we try to do, which is try to scalp the market as we're trying to show you here. So we talk about, I get on the floor and I talk to some of the traders in the pit. They give me some of their insights as to what might be happening, what might not be happening, and we kind of share those situations, especially some key levels that we trade off of. So those are kind of things that we have here on the floor, and yeah, obviously we have a whole slew of information that we uh, are privy to, and Reuters, and not that everybody else is, but I think we get them just a little bit sooner, and then definitely the talk around the floor you get probably with us more than anybody else. So. I just want to, preempt here and to say that if anybody wants to ask any questions as the program goes along, please feel free to ask them. Uh, I'd rather you, send me your questions as we're going. That way I have a good feel for whether I'm saying the right things and you understanding what I'm trying to say and convey. And so if you please feel free as the program goes along here to type in any questions that you might have as to any of the things that I might be showing you or trying to explain to you. So let me tell you what we're going to cover in this webinar and this little hour that we have here. Um, you know, how do we get into and exit our trades? I think that is the one thing that I help traders a lot with. We show and we try to determine. We try to. I think the biggest problem that I've seen a lot of traders have is being able to have patience and waiting for situations to occur, or waiting for the setups, I should say, to happen, and to be, and then not to get too flustered when the market makes a sudden move one way or the other, and maybe we're not on the right side. So those situations obviously do occur. They obviously are there, but we also use our stops into getting out of those situations when we have no idea what's happening, and plenty of times where we have no idea what's happening because the market gets the information way ahead of us, and we are just you know you know trailers behind, and hopefully what we try to do is to let the market set itself up, and then for us to be able to take advantage of that setup. And that's what we try to do. So what we try to do is show you where those setups are and what the market is telling us when they move a certain way and when they do something. I think I have a good grasp of sometimes why markets intraday tend to make these mini moves, as I stood in them for many years, and they kind of explained it to me when I didn't understand it, especially in my wallet. So those things do happen all the time. So we're going to be showing you when to enter and exit a trade, what the floor pivots are, and they're a little bit different than some of the pivots that you might be used to, and are accustomed to. Not exactly the same as an equation that everybody has, the high low divided by 3. We have our own pivots that we get off of the floor, and we use constantly to keep our traders on the right side of the market. What our targets are. Sometimes, obviously, what we're trying to achieve in our targets and what we're trying to achieve in our trades. We try to keep things to um, a tight little situation here where we don't overextend on both the profit side and the on the loss side, only because we feel that it's important to make sure we come back the next day. We try to hit at a high percentage of trades, and that way we don't have to trade that often to be able to achieve some profitability. We're going to show you what our template is that we have in our room here, where you can see what I'm looking at every day and what I use to explain some of the setups, and try to understand sometimes what the good trades are, and also very important to try to squeeze trades sometimes to be able to achieve more than a 2-point objective, which is what our objectives are on a profit potential on a trade. And sometimes we obviously want to be able to achieve more than that, and that's only because of what the market gives us and tells us, not so much as to what we think is going to happen. And then we'll talk about some little money management situations, and a little bit on psychology here, because I think that's a big thing for traders to try to understand what's going on in their head, because sometimes I don't understand what's happening either, but I try to quantify it to some extent. All right. So again, we get a pivot off the floor. I talk to some traders. We generate a level where we think the market is going to bounce off of, and to trade around, and what the pit itself, or what the traders itself are looking at as an important level to be considered. And we give you that level, and I give you the levels every morning. So why don't I just take a quick brief second here to give you the levels that I put out this morning, um, in the on with our in our with to our clients, and we can talk about, maybe I can show you some live screens here with live charts, when I get through the presentation, this presentation. I can show you some live charts as to how these levels worked out and how we traded them, and then hopefully we can expand on that later on. But let me give you our levels for today. Our pivot today in the S&P pit was 1976. 1976. We had resistance above at 78, at 81, at 86, and 91. So we had support down below at 72, 68, 63, and 59. Again, those levels were put out to our clients, before the market opened, and these are levels that we trade around, and what we are looking for as far as objectives and levels to try to hit with positions, so on and so forth. All right, and this first slide here. Let me see if I can. All right, we have market kind of bouncing up and down. Now, I'm using a bond chart right in here, but the reality of it is that we could use and adapt most of the tools that we're going to get to most markets. I have tried to adapt this so that if you're trading gold, or if you're, well, let's try to stay away from gold and oil, but I know a lot of you like to trade gold and oil. It's volatile markets. I like to trade markets that I have some feel for what's happening. I have an idea of what's going on. I have some reason. I can at least put some reasoning into why the markets are doing what they're doing, and I find that with the bond market, which I obviously have a little bit of a love for, because I traded in there for so many years, and I think I try to understand what's happening there. But lately, I think it's going over my head, because the Fed's involved too much, but that's another story. Anyway, and also equities, because I think everybody understands equities. It's a very highly traded market. There's a lot of volatility. It's not like you're going to be lacking to get in and out of your trades. So we trade markets that we understand what's going on in there and what is happening, versus a market that's, I think we should go trade oil because I think oil moves and I think everybody likes it and they talk about it, and somebody's giving you a level to trade it, and you know at least we dive into a market, at least we try to dive into a market that we have some understanding of what is happening, and why it's happening, and this is why we stay with the markets that we trade, basically financials, which are bond markets, the 30-year and the 10-year, and also S&Ps, which obviously everybody knows, I think, what S&Ps are, the minis. So, but like I said, the chart that I'm showing you here is a bond chart, but we can, and you will see, we can adapt the technique here to an S&P chart, and they do have the same characteristics. I think ever since the markets dive into electronic trading, everybody has the ability to have a chart in front of them. Everybody has real-time charts in front of them. And be honest with you, when I was in the pit trading, I didn't have such capabilities. I had, unless I lugged a big heavy screen into the floor and tried to set it up next to me, and then connect some wires, and there were 600 people in there yelling at me, "What the hell are you doing?" That wasn't going to work out too well. So yeah, but things have come around a long way, and so consequently, I think everybody's gets charts and have charts, real-time charts, and obviously everybody's learned about them. But what we try to do is expand on what they're telling us, and that's where we come in. So we have a pivot here, as you can see here, this top line up here. Definitely the pivot that we got off the floor, not so much a pivot that you would get if you, took the high and low, divided it by whatever price you get, and you come up with some nice tidy number that you got to remember a lot of people have, right? I mean, we're trying to be a little bit different. We can't just do what everybody else is doing, and or else it's not going to really work too well. But but yeah, we got to be. I mean, there's a reason that number and that pivot, mathematical equation gets passed around so much. But for us and for our what we're trying to do, which is actually trying to trade the market every day and to be able to take some profits, a little bit of the profits. Our philosophy is to, trade, take a little bit of profits, because at the end of the day, at the end of the week, those little bit of profits add up, and then we're able to come back the next day, which is very important. We definitely don't want to blow out your account, and that's something that we work highly to work against, and especially with our traders who are having a tough time. We talk about money management, stuff like that. But we have our pivot up here, which is this top horizontal line, and the market bounced off of it here a couple times, and finally did decide to get through it. We had an entry point right below this horizontal line that we were able to get short. We had good logical reasons to get short, and the target down in here became probably maybe a first support level that we had, that we gave away, and you could have targeted that level as an exit point for your short, and or you could have played it for a little bit of a bounce. Remember, markets do not go straight down. We try to find the ebbs and flows of the market at various key levels for us to be able to take advantage of those situations. So we feel that I think that is, it's very difficult for some traders to hold a position all day, watch market fluctuations go up, then come back down 10 points and rally about 5, and come back 4 and then rally 7, and then at the end of the day you're up or down 2 points, but then you miss a lot of opportunities in the middle. So we're trying to take advantage of those opportunities along the way, and help us make a little bit of money at different times, instead of looking for one big home run, as so to speak. But like I said, the market came down to this first support level, which again could have been one of our levels that we gave out, and that'll be a target for you as the market starts down ticking. We have a trailing stop that we like to use all the time, whether it be S&Ps and financials, where you are constantly moving yours and adjusting your stop so that you try not to let any decent winner turn into a loser. The last psychological thing that you want is to be able to say to yourself, "Oh, I had a really nice winner, and then I ended up keeping my stop, didn't adjust it, and the market turned into, market turned around and it became a losing trade." That's bad for your psychology. It's bad for your trading, your trading psyche. You want to be, you want to feel good about putting on your next trades, and having a winner turn into a loser is, tough to do sometimes. Not tough to do with these markets, I should say, but it's tough on the psyche, and we try to keep your psyche clean. So we believe in trading trailing stops a lot, whether they be, but whether they're from financials and or equities, but we also try to let the market kind of tell us where those stops are, versus, just well, we could do it two different ways, but the real way of doing it is probably be to letting the market tell us where those stops are, and I'll show you that when we, maybe if I can find a way to get to my live charts here, we'll be able to show them. All right, and so to this point here where we target our first level, our first target, you could have easily targeted the short, and or you could have been able to buy them and then take advantage of this little bounce that the market created for you up here like this. Came, I should say, right here. It's a little bounce that the market created off of our support level. So you would have been able to, maybe, if you missed the break to the downside, maybe been able to take advantage by using our support level and take a few ticks off of that. And so in our S&Ps, we are looking for about 2 points on our stops and 2 points on our profit potential. In our bond market, we're looking for about 5 ticks, about 150 to 6 ticks is $180, and about same amount of about 3 to 4 tick loss on the downside. So um, that's where we're at, and we'll try to stay consistent with that to be able to make sure that we come back the next day, and to be able to stay focused on the trading instead of staying focused on what you feel the market's going to do. But again, we had a market that bounced off of this little support level that we had down here. We had another entry point right in this level that was able to get us into the market to be able to take advantage of the next move down here, which was our next level, and also our the we call floor support level, which is also the next level that we gave out. Then you can see here, you could have done the same thing. You could have been able to buy them against this level, and or you could have been able to just target that as a exit point for your short. Again, I just want to remind everybody that if you have any questions, please feel free to write them down. If you don't understand anything, um, any time during the course of this conversation is a good time to ask a question. So you don't have to wait till the end. And again, it gives me an opportunity to know that at least I'm explaining things to you a little bit, and hopefully we're on the right track. And if not, we'll get you back on the right track. So absolutely, positively make sure you send me questions if you have them along the way. So again, this is another way of being able to use our level. You could use it for a little bit of a ebbs and flow bounce here, and the market did continue to push itself down, and so on and so forth. But this is over a long, obviously the meat of the day trading comes between, we think between 8 and 12 Chicago time, where most of the good trades occur, and then you got a lot of this stuff in here where you get a lot of uh, you know uh, non-movement or ebbs and back and forth trade, tough tough trade in those situations. So that's that. So we also do like to use trend lines. I think trend lines keeps us on the right side of the market. And also, we have to sometimes adjust your trend lines. As you can see here, we started a little trend line, and that we put on this first uh, move up here on the upper level. When we came back down to it, we bounced off of it, and we came back down here to this level. It broke through, gave us a little bit of a down tick, and created this level down here where we reattached our trend line. So we like to uh, adjust, so to speak, your trend lines to be able to adjust to what the market is doing. Don't fall in love with a trend line and say we lost it. As long as it touches it a couple places, I think it's a good trading tool to be able to use, and use your trend line to be able to find reasons to enter a trade. Now, we have all sorts of traders who are trading. We have very aggressive traders. We have traders who are obviously a little bit more risk averse, who are trying to watch the cost of doing business. We understand the cost of doing business is up there, and we understand how that we don't want to take too many trades in the course of the day, obviously. But I have some clients who are obviously listening to me and on the floor, and they have the ability to trade a lot more. So I'm giving a lot more opportunities, a lot more trades that I call out in the room. You're not going to be able to take all of them. But the most important thing that comes out of what we do is that you understand the setups and then customize these setups to your trading ability. I'm not going to be changing who you are. I hope to be adding a lot more information to your trading abilities and to your trading setups and what you're looking for and how you're trading. But I'm not changing your style. I'm not changing if you're risk averse or not. And I also take into account that it costs a lot of money to trade sometimes, especially if we trade a whole bunch. I had one of our traders who uh, came to us and was trading. He literally had 75 um, contracts that he traded, S&P contracts in a day. In a day. Now, to some of my traders on the floor, that's not a lot, but to the most of the retail customers, that's a lot of trades. And if you do the math as to how much that would cost you in commissions, he was racking up a whole bunch of commissions when he came here. And what we did was we slowed him down a little bit. We told him what trades that he needs to find to get comfortable with, and what suits his mind and mind's eye, and what he can recognize, because there's a whole bunch of situations here during the course of a day. It's important to recognize, to trade the ones that you see, that you feel comfortable with. And so we got him going from 75 contracts to, well, when he was trading ones and twos, he was trading like 10 or 12, which is about 5 trades a day versus God knows how many trades he put on. But those are the kind of things we try to do and focus on, because we do understand the what cost of doing business is, and we focus in on that. So we're looking for about 5 trades a day, and sometimes we get them, sometimes we don't, and maybe we'll even get more sometimes. Well, who knows? But those are important aspects. And so when I show you this trend line over here, I'm trying to show you that trend lines do work. Would you take every trade that will come off of a trend line? Probably, maybe not. Maybe you would, depending on how you feel about the market in that day and what's happening. But again, trend lines do work. It's part of um, a good trading. You kill it? No, it's you need to have that in your arsenal of trading techniques, and how you use these charts to be able to help you out, because a lot of people use them, and so there's not a bad thing to have. All right. So here is a S&P again chart. Again, we showed you. This looks like almost like a bond chart that I had earlier. But again, the market is giving us entry points, giving us levels. These are levels early on. This is an entry point to get short. We had our pivot is, let's see if I can, our pivot is somewhere up here in this area, and we started trading below it. We couldn't get above it. We couldn't get above our blue band, which is a Bollinger Band, which I think works really fantastically well here with what we do. And the market gave us a little bit of a signal here for us to be able to get short and to be able to catch this move to the downside. Very nicely, it came right down to one of our levels down in here. Again, you could have bought the level and been able to take a little bit of a pop to the upside, counter trend. And remember, if we're going to counter trend the market, sometimes we're going to be able to hit it perfectly, and sometimes we're not. But we don't know that when it happens. That's why we talked about earlier about having a lot of rotating stops, trailing stops with us, because when we do hit it, you're going to get a nice move, and sometimes we are going to get the higher low of the day. Okay. And so trailing stops helps us with those abilities to take advantage of those levels that do become the high and low of the days. And but so we, again, whether it be a bond chart and or a S&P chart, the market gives you indications of what uh, where to enter the trade. I mean, we are trying to find reasons for us to enter our trades. We're not creating a logical reason like, oh, the market is going down, so I have to sell it. That's not, and that's not one of that's not really a good reason for us. So that's something we have to try to stay away from more than anything. Um, so when we came here to this level that I said is support, the market kind of maybe tried to bounce a little bit, maybe didn't. But what it did do was create a level that the market could not get through right in here. So this support level, right, which the market was testing when they came down here, and now becomes a little resistance level. So we could have been short here with an out right above all these tops, and again, it would have been very nice. You stalled here for about 2 hours of doing nothing, and then continued to move down. But we were in the pit, or if I was in the room, I would have said, well, we want to be short here, and we can get short and stay short below a certain level. And if that level never got hit, then you're situated to be able to take advantage of the next trade, or next push to the downside. The one thing that we talk about a lot is to be able to help the trader stay on the right side of the market, whether it be short or long, and when those market switches occur. What I try to do is we try to teach you that in our class. We try to teach you it and try to expose you to it and why markets would be changing and what they would be doing. We had a classic example today of the market rotating quickly to the downside, where I think we could have been able to catch a lot of that move, and then went down to our support level, and easily I think we could have been able to get you along for maybe not the whole, well, if you bought them down against our support level, then you were able to buy them on basically a point off the low, and been able to maybe it did hold certain areas. You needed to, depending on how you're trading, to be able to hold on to some of this and be able to catch the ride back up here. So again, hopefully I'll show you this. Hopefully I can switch my screen here so I can show you my our trading charts, and then be able to explain all this stuff too with the live charts that we have today, because I like the live charts more than anything. It kind of explains what I'm trying to talk about here. Again, reasons very important. Those are why we trade. This is the one thing that we focus in with our clients more than anything, is to be able to explain to them that you need to have reasons to get into your trades. We are patient with that. That is some of the problems that some of our clients have, is that they don't have the patience to be able to wait for the trade. But if you tell yourself that you are going to put 5 trades a day, and if you have to spread those trades over a course of 4 hours to 5 hours, you're talking about a trade at an hour, and sometimes we're going to get 3 trades in an hour. We don't know, because we don't know what the market's going to do. But if you can say to yourself that this is what I'm trying to do, then hopefully with a little bit of patience, you wait for the right opportunities. And once those opportunities come in, then you'll be able to take advantage of them. So um, that's what we're trying to do here, and to be able to be patient for them. So again, have reasons, and then wait for those reasons. Once they click in and they make sense to you, and you understand them, and you feel good about them, then put on the trade and be able to work the trade after that. Well, again, the patience is the most important thing that most of our traders are having an issue with, and waiting for those opportunities. And I'll be honest with you, so do I. I mean, I trade all the time, and the hardest thing for me to do is to not trade. And that's what we try to, tell most of our traders is, again, this goes to the psychology part. And so sometimes it's good that you're hearing me talking instead of trying to trade and not find anything. Or if you're one of our clients, you can ask me what you think and what do I think, and is this a possibility? And you can have a normal discussion between traders, because that's what happens on the floor. We're constantly talking to each other and trying to see what you like and what you don't like. So as the market came rotating down, came to our first support again. This old support becomes resistance. This is classic, and that market stayed below it and continued down to the lower targets, and gave us reasons to enter our trades. And also, what this market did was give us reasons to exit our trades. And those are the things that, again, have to go hand in hand with what you are doing. I mean, you have to realize that not only do you have to have a reason to get into the trade, but where you're getting out. Okay, it's easy to say we're getting out with 2 points, but sometimes it's easier if you let the market indicate where you should get out instead of having just a standard 2 point stop. All right, which is another thing we talk about all the time. All right. um, just let's see here. All right, these are again, this is the bond chart, and again, like I said earlier, we are focused in on letting the bond chart uh, tell us what uh, we actually are letting the charts tell us when and where to enter our trades. Not so much, like I said earlier. Oh, I feel the market's going down, so I think I have to trade. That's not what we're trying to do here. So in this chart here, we throw in our trend line that we have shown from earlier day that we talked about earlier and how they work. This was a reason for us to maybe enter a trade. Here, maybe it was a reason for us to get short on the trade. Uh, could have been able to get short here with an exit strategy above a certain level up here. Um, market kept doing really kept you really could have gotten short over here at this level, and then once we got here, the market did not uptick past that old support level. And there was another reason where you could have said to yourself um, that you wanted to be short and stay short below that level. Okay. So again, reasons for entering our trade. This is a bond chart. We can use the same thing, like I said earlier, like using S&P chart. So what we try to do is we try to focus on our any of our work on the charts and be able to use them to our advantage, whether they're bonds and or equities. But we do like to trade the charts, or trade the instruments, I should say, that we understand and are comfortable in using. Um, this is what we look at every morning. These are our charts that we have and what we use. And going from left to right, we have a 5-minute 10-year bond chart, and followed by a 30-year 5-minute bond chart, followed by a 60-minute ES chart, followed by a 5-minute ES chart. So sometimes we kind of combine both to help us 5 minutes and a 60-minute to be able to help us with the direction of the market and where we're going to go. All right. So here's just a quick offer here for us. This is just if you guys are interested. Just I think you got the information down on the bottom there with the chat window. All you have to do is click down in that link there and just fill it out. Give us your right email address, only because we're going to invite you back, and we have to give us your right email so that that doesn't go to you know uh, doesn't go to wherever it goes to. So keep that in mind. The moving averages that we have on our chart. You know what? I'll get to that when I try to show you our real charts, and I'll definitely answer those questions for you. But please keep asking me questions. I really appreciate it. At any point, throw in any questions that you might have, and that'll help with further explanation of anything that you might have, and also probably somebody's asking the same kind of question or thinking about the same kind of question. So definitely keep asking me the questions. It does help, uh, you know, with explanation here on my end. All right, let me see if we can let me see if I can, all right, you gotta give me 1 second here because I'm gonna try to show my other screen which shows my charts, and we didn't practice this before, so let me see if I can do this without messing everything up here. Dun 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 dun. This does not look good. Let's see. Uh, Let me see if I can do this. Okay, here we go. Mm, just give me 1 sec. All right. Just give me 1 second here. They're loading up these projectors so that I can show you our trading screen here, and we'll be able to uh, move it along here. All right, I think I got it. All right, there we go. Perfect. Okay, I hope you guys can see that. All right. Is that good? All right, good. Thank you, Yana. I appreciate your help. All right, so this is our chart. So we have, like, again, like I showed you just a little bit ago. And this is, again, from left to right, 30-year, 10-year bond chart, a 30-year bond chart, a 60-minute ES chart, and a 60-minute um, 60-minute 60-minute ES chart, and then a 5-minute ES chart. And let me see if I can get my trading. All right. All right. Uh, all right. We have again the levels that we had. Our pivot, like I gave you earlier, was right here at the 76 level, which the market kind of, as you can see, traded higher earlier this morning, and then um, once we came back up to it right now, it's trading lower. But the key here is how could we have taken advantage of this move? Um, and that's a question that we're all trying to ask here. Or how could we have taken advantage of any of these moves that we've gotten here? So just let me get this out on a wider screen here. All right, so this is our opening right in here, right in there. We opened up with this, uh, stuff that the market over here traded overnight. A lot of stuff that just kind of, once the European markets opened up, they kind of came in this little range and kind of hung here. Then we opened up right around here. We had 76 being our pivot, which is this, this band right in here. All right. So, number was coming out at 9 o'clock, so that's a deterrent for us if you want to do anything. But our moving averages, let me give you what our moving averages are. we have a blue band that's basically the Bollinger Bands that work really nicely for what we try to do here with these equities and financials. They do keep us on the right side of the market. So there are straight um, moving averages that you get off of Bollinger Bands, and these they are right up here. Our green band, which is right in here, is a proprietary average that we have calculated here at PitIQ. So that's something that we like to use, and it's just a little average that we put together. When the markets are kind of moving a little bit, they kind of help us out here a little bit more versus more horizontal like it is right now over the longer term. So that's what we try to look at, and the rest are just simple moving averages, 50 and 100 or 200. But the Bollinger Band keeps us on the right side of the market. We again had 78 up here. If our traders, some of our traders had a little buying opportunity once we got above our blue band, and took a little bit of a trade coming back up here um, uh, to our 78 level. If you traded our 78 level, which if you just traded it, like I said earlier, and sold the level because it was a resistance level, we have a 2-point stop, all right, 2-point stop on these trades, which never got hit. You obviously have to wait a little bit of time here, but the market did after about an hour had this little bit of a break. Now we can see here, you know, we had an entry point for some of our clients right here below the 74, which we used as a impetus to get short. Okay, and that helped us get into a trade to be able to catch some of this move, you know, down in here like that. That move was caught simply by being able to get short right up at this level. Again, the market was telling us, and to be able to catch most of this move down here. Our next level that we had down here was the 68. Now, we had 72. Obviously, if we got short right up here against the 74 area, the 72 would have been our first target, right? So this is where you'd get out of the trade and then have a trailing stop to be able to catch this move here down to our next level down here at 68. Obviously, you need to put more than one contract on if you're going to do something like that. Market this move right in here was a little bit of a eye opener for us to be able to get short, stay short. Once we were able to get through that little area there, the market kind of gave us a reason to get short below the 74 area to be able to catch this move here. Our level down below was 68. They got down to 67 and change here, and you know, was able to, if you did get long there, or if you targeted that level off your shorts, you made a nice little move off of that short. If you did buy them here, which is again our level, you're again we target 2 points. All right, but then what happened was the market also, I had said that we would want to stay long above, as long as we stayed above 68. Once we got here and held, made this move up to the 72 area, and then they came back. I said, well, you know, if we want to stay long, if you want to try to squeeze something, you want to stay long above 68. Anything below 68, probably you want to be out of any longs. This allowed us, once we got up to this level and we held our blue band, again, probably would have said anything below 70, you want to get out of any longs. And obviously we were trying to target, this is again our pivot for the day up here at 76. This is where we would have been trying to target off any of this long that we would have maybe tried to be able to squeeze. Again, these were all real-time situations that I was talking to with our traders on the floor. We did have a little bit of a buy above the 60, above the 73 and a half, right around here, which again, remember if I said the 74 was a level to get into your shorts, now if we trade above it, the 74 would be a level to be long. So consequently, that opportunity arose to be able to make a catch this little mini move up here up to the 76. Now we're not getting much of anything. So which is kind of probably a, you know, as far as we're concerned, we had probably one trade up here, another trade down in here, another trade here, and another trade in this area here. That's about 4 trades a day that we could have easily gotten off of the levels that we gave out, and that'd be about it. I mean, we don't, again, we're looking for about 4 or 5 trades in the course of a day, so we're not going to get too caught up with any things that we do. Again, if anybody's, you gotta help me here with your questions. If I'm saying something that you're not getting, please feel free to ask, whether I got the pivots or our levels or why I went through. Any questions, please feel free to ask. All right. Again, our green band here is proprietary to the floor of the Pit IQ. So uh, the pivot here as well as the green band did come right up here. So there's a little bit of resistance up here, at least the first time to it. And the market's kind of coming back here and just kind of doing nothing here for the last hour or so. So, but just showing you that what we tried to do today in regards to some of the trade that occurred during the course of the day, and then how we tried to take advantage of what the market was kind of giving us. So if you were with us, that's what we've been looking at. Again, the levels that I gave you were all given to you prior to uh, the trading day. So that's a good question. Would you be able to explain the use of the pivots and how we determine where the market is going using pivots? Well, the pivot is just an area that the market, the traders like to use as flipping points for being long or short, having a long or short bias. All right. So, and on our situation right in here, if this is our pivot right here at 76, and we started trading below it over here in this area, we have to maybe look for a reason to try to get short this market, especially since we got below our blue band over here. All right, so when we came back up here, now basically for us to continue to have a change, or to be able to get long this, or to stay long, okay, we need to get above the 76. So right now, even though we came up here and we touched the 76, and we're coming back down here, we haven't really lost this kind of mini bearishness that we created once we broke. We start trading above the 76, then maybe we'll make new highs on a day, especially since we're coming here to the last couple hours of the day. We try to stay away from the markets when they are trading. When the bond market closes, which is around 2 o'clock, we feel that there's a lot more volatility that comes into play, unknown volatility, and something that some of these traders aren't able to hedge, and so there's more volatility, much more. The volatility is so quick that it's hard for us as traders on the screen to be able to take advantage of it, especially when there's extreme volatility. It's just not fair to get us into a situation where we don't have a little bit of control. And as it is, we don't have any control, but we lose a lot of control here if the markets start getting crazy and start trading after the bond guys go home. So we feel there's a good correlation between the bond market and the S&Ps, and so we like to use those correlations. And when one of those markets close, it's not like we don't know what to do. It's just the fact that there's more volatility that comes into the market that it's not that good for us as traders to be able to get ourselves into. All right, so again, please keep asking questions. I appreciate it. So that's kind of what we did here. Now let me see if I can get back to my. So any questions as to what we tried to do this morning on the floor in our trading, before I switch off the screen and go back to our slides? Again, this is what we do and during the day, every day. We are in a little room here where we talk to our traders and we throw ideas off of each other. We talk about the markets that we're trading, and we focus in on that. And it's something that are we like to do here, especially coming off the floor. That's what we have a little niche to, and we can again talk to the traders that we talk to and get that information back out to you. But we trade only markets that we understand, try to understand. There's a lot of markets out there, obviously. I don't profess to be any expert with euros or oil or gold. My friend trades oil market, and I am at a loss sometimes to explain the volatility, and he's at a loss to explain the volatility or the movement in those markets sometimes. So, and he's a professional trader, so what am I supposed to do? Anyway, but that is, uh, yes, do I have anything that will help determine the entry and exit points for any market? Like I said, I think that what we try to show you and what we try to do is to show you where those entry points are and to be patient and wait for them. Absolutely. We do have a way to help you determine as a trader our entry points and our exit points. There's absolutely no doubt about that. That is what we are trying to do, and that's how we try to transform some of our traders because they get a little bit antsy sometimes of trying to find out how to be able to take advantage of a move, and we definitely are trying to do that. Yeah, DAX also is again equities and or financials we could talk about. Again, I'm sorry that I don't trade some of these other markets, but we stick to the markets that we know something about, and I think it's a good thing that we all kind of do that more than anything else. I think it's a good thing for all of us, but Bund is also closely associated with bond market. So if you're trading a Bund and if you like how the Bund trades, maybe if you come over to our side here and we trade the bonds, I think we'll be okay. The euro against the dollar, where's the market actually headed? um, I have my ideas, but I don't trade the market, so I'm not gonna uh, not gonna say anything. It all depends, obviously, on what the Fed is doing and how they are going to manipulate the dollar and interest rates. So um, obviously, if you feel interest rates are going to go up, obviously you would think that the dollar might be a little bit bullish. So I just gave you an opinion, even though I didn't want to. So, and only because of what the Fed might or might not be doing, and what Europe might or might not be doing to their economies. That's all. Nothing more intellectual than that. All right. All right. So again, thanks for the questions. Keep coming. All right. Let's see if I can get back to the slideshow here. Do I just X out of the projector thing? Oh, there it is. Okay, good. Thank you. Thank you, Yana. I appreciate that. All right. So let's get to the next. So I like to use real-time charts instead of these the slides that we have. It gives us a little bit better indication, and this little slide here again, this kind of trying to find a way to keep you along once we hit this, once we started sliding down, once we got above our blue band, we needed a reason to get long, and we will find reasons to get long, but we need a reason to say to you that we want to be long before you say, okay, the market's going up. Are we starting to trade above our blue band? Do we hold a support level? Do we hold another support level on the way back down? All these things come into play. All these things we try to talk about, and uh, this is as big as I can get them. So these levels that we have in here, again, I think the chart here, as long as we hold above these certain levels, that they become bullish and be able to take advantage of these moves one way or the other. All right, we talk about a little trader psychology here, and I think that's an important factor that a lot of traders kind of miss out on. And we always I always try to get you back to reality sometimes, especially if you're having a bad day, and so like it happens to everybody. We just our timing is off sometimes, or the market's not giving us that entry point, not giving us that key thing that we are always looking at to be able to say, all right, this is the trade that I want to get into. This is the trade that I think is going to be giving me all the reasons that I should get into them. And we need one more opportunity, and it just one more tick down or one up tick, and it happens. It happens. We're not going to get that one extra tick that's going to get us filled on the trade, and then the market kind of runs away and gives us that nice little opportunity that we thought was going to happen, but we didn't get in. So we as traders, I've all these all these kind of different feelings have happened to me probably 10 times over, and you got to learn to deal with them. And so you some of our traders they just want to call the vent, and they decide, let's talk about what's happening here. Why did this situation happen? I mean, sometimes it's very difficult to understand that we just missed out on a trade, and when we should have been able to get filled or not, when we didn't, and then the market went our way. Stuff happens all the time, but no single trade is important. It's the process of trading that's important, and which is something that I should focus in on. Very important to be able to focus in on what's happening in front of you, and try to keep those other distractions out of the way. Try to we had interesting day yesterday where we should have gotten filled there a couple times, and we didn't, and it just those opportunities just got missed out, and those things are going to happen. So focusing on the process of trading, and that's what you're going to be doing well on. I believe it's not my job to know whether a trade will be a winner or a loser. It's my job to recognize the signal and I act upon them. Very important recognition of our trades, the recognition of our setups, the recognition of which way the market is going, which side of the market should you be on, and what am I trying to do here? Where are my goals and objectives in this trade? Am I going to be able to get above our pivot? If I buy them 2 ticks below, is it going to continue to go up, or is our pivot is that the place to buy them? I mean, those are the things that are very difficult, and those are the things uh, that we have to focus in on. We talk about in our trading. These bells are going to go off here, so I'm going to stop talking because they're going to come like one after the other really quickly, and I can't hear myself talk, let alone try to talk. So give me 1 second. Okay, just those are bells for the pit close of the cattle uh, pits, and they close a little early. They have a nice afternoon. They start at 10 o'clock and leave at 1 o'clock. How are they doing? They have a nice life, those guys. All right. So recognition of the trades, recognition to enter our trades, and recognizing the signals and act upon them. Those are two different things, but very hard to do, and take a lot of time. I mean, that's why you're with when we get you involved in what we're trying to do here, you're with us for about 4 to 6 months, and because I think that takes a little bit of time to understand exactly what's going on and why it's happening and what the market's telling you, and those take a little bit of time to notice and to recognize and to be able to act upon them. So very important. Recognition of the trades is something that you have to work on. It's just like that's probably the hardest thing that I could tell you that will happen to you. Be patient and wait for the opportunities. Very important. We talk about recognizing trades. Then at the same time, once you recognize the trades, it has to be triggered. And if sometimes it's just not going to get triggered. Okay, we see what's going to happen. We know what's going to happen, and now we have to wait for the market to get into that situation where it's going to trigger that trade and make it happen. And being patient and waiting for those opportunities is probably the most important thing that I can tell you. That's and also the hardest thing. But it's hard for me too, because I have to sit there and wait and be patient just like you do, and wait for those opportunities to get clicked in. And when the time is finished, it's forgotten and focused on the next opportunity. I can't tell you sometimes how hard it is for everyone to take that loss that you have to take, and then to say, all right, well, what's my next trade? If you're seething over the last trade, and if you're like, you made that last second, this decision to enter the trade when you maybe thought it was going to be a little bit too much, or maybe you thought it was going to, market was moving a little bit too fast, and maybe you should have stayed out of it, but you saw something and it was, telling you to do it. Okay, you know what? You did it. You lost. You got to move on. If you had the proper reasons to get into your trade, again, logical reasons. That's what we talk about. Those are the things that we have to learn. Once you get those reasons all figured out, and all those reasons all made sense, once those reasons made sense, and once you decided to enter that trade, and the trade did not turn out for you, you got to move on. Okay, it's not good to dwell. It's not good to focus, because you're going to lose the opportunity for that next trade. You're going to be so caught up in what we just did, and how you should have not done it, that you're going to get all caught up in the wrong thing. So very important to move on. You can't sit there and you got to forget about it, because you know why? Because every day is a new trading day. Every trade's a new trade, and there's plenty of opportunity down there in here to be able to let one trade bother you. Okay, I'd say that if we get in today's trade, just today's trade, I'll give you a little bit of a call here on what I think. If we get above the 76 and a half, I think we push to the highs, and maybe even to that 81 level that I have. If we can get above that 76 and a half, that's about all I'm going to say. And we don't want to be short. We do want to get short below 70, but that's about it. Okay, so those are opportunities, and I got a seven above 76 and a half and below 70. Now, in the middle, are we going to not do anything? That's where the patience come in. We have the setup above and the setup below, and in the middle, we have to show some patience. And we might trade the middle the rest of the day, but this is where your patience comes in. This is where you test yourself as a trader. All right, so a little bit money management here. This is, I don't know if you've thought this idea before, but this is something that helps us keep our traders from thinking too much about the money, which is what a lot of traders are thinking about when they put on a trade. They're thinking about the money and not thinking about the trade itself. You have to be focused in on the opportunity, and let the market give you those opportunities, and then let the market tell you where the exit point is. Hang on one second. Just one second here. Okay, sorry for those dings. Anyway, so what we try to do when we talk about money management is to take the money aspect out of the trade, and to say, okay, this is what you're going to do. This is how much you're going to risk. This all comes within the parameters or your acceptable trading that we talk about. We talk about everybody's portfolio is going to be different. Everybody's risk tolerances are going to be different. But what we try to do is talk about each one individually, and how we, manage their accounts and their lot size. So in our little example here, just to make things even, just to make things easy for all of us, is that we're going to take the amount of your portfolio. Let's say for us it's $10,000, and we're going to say that we're going to risk 10% of that um, portfolio every day. Okay, so we're going to have 10% risk on that portfolio every day. We're not going to try to risk more or less than that. All right, so that comes out to $1,000 a day. Yeah, that's how much we're going to risk. Now we're going to take that $1,000, and let's say we're going to simply put on no more than 5 trades a day. All right, 5 trades a day. So now if we divide the $5,000 by the 5 trades a day, we come up with $200 a day. Trade, I should say, a trade. So that's how much risk we're going to put on per trade. We are going to risk $200 on each trade. Now we go backwards. Now we're saying to yourself, all right, if we're going to risk 2 points on one S&P contract, one S&P trade, I should say, that's $100. 2 points is $100. So now if I'm going to say to you, sorry about that. If I'm going to say to you that we're going to risk, $200, so that means now you can put on 2 lots. Okay, you can put on 2 lots for each trade that we put on that day. All right, and that way your risk is maintained. We're not thinking about the money. You know how much you're going to risk. If that's too much to risk, then we adjust that. So then you put on one contract and do it that way. Either way, okay. What we try to do is we have to try to take the money aspect out of the trade, because if you start thinking about the money aspect of the trade, you never think about what to do with the trade and how to trade around it and how to trade the proper way, and using the market to tell you where to get in and where to get out. And sometimes the market is going to tell you where to get in, where to get out at 3 or 4 points instead of 2 points. If that's the case, then you can adjust. If you trade 2 lots and you're risking 200 each trade, and that's about I mean, you're risking $100 for each of the 2 trades. So now you might do 1 lot and risk 4 points. Same contract, same amount of money that you're going to risk, but because the market's more volatile, or the market's, something's up. Let's say the Fed is deciding to do something ingenious, and there's more volatility, or some geopolitical event that's going to occur, and there's more added volatility. Obviously, you decrease your size, but your risk tolerance is the same. All right. So that's what we're trying to do here. I think it's a important aspect of trading that we throw into what we try to do more than anything else. All right, again, do you have any questions? Again, I'm opening the floor here to questions again, to anything that you guys have been listening to, or have any questions about what we do or how we do things or what is going on, so that I can help you try to understand what we try to do. Please feel free to ask anything that you may want to ask. All right, so again, I'll just repeat it here really quickly. We do our report from the floor. We give you a daily update as to what is going on, what we feel is happening. But what we try to do more than anything is to let the market tell us what to do. All right, that's a very important concept here, is that we're trying to let the market kind of give us direction, telling us where we're going to go next. What are we going to get short this market? So what we try to do is, over the next 15, 20 minutes, especially after the opening, we just kind of just let things play out and then decide what we're going to do. We have to let the market paint itself a couple bars here and there, and then see what numbers are coming out, because obviously we don't like to trade when there are some fundamental news that comes out. We feel that there is added risk involved here when there's some fundamental news, and there's no reason to get down a whole bunch of money in the morning on your first trade just because there was a number that came out and it was, it made the market move, for no reason. And so we can just stay out of that, because we're going to have plenty of opportunity to trade after the number. These days, you can have any geopolitical situation comes up and something goofy will happen, and we'll get some volatility no matter what. So these are strategies that we talk about. We get you the market information, get you the information from the floor, including our pivots. We'll get you our key levels. We talk about what to look for. We talk about what fundamental news is coming out before numbers. What economic reports are coming out. We also talk about what the Fed might or might not be doing that day. And so these are all things that we discuss pre-market opening. We also give you the levels that I gave you earlier. What we do in our course is also make sure that we show you how to create the levels. I put these levels together myself, but the thing is that we in our course also show all of our traders how to put those levels together, and what to do and how to get it done. So those are things that we stay focused in on and try to share with our traders all the time. All right, so I guess nobody has any questions, and so hopefully you guys understand everything we talked about. And